Friday the 12th, good morning. I'm Guy Johnson alongside Valerie Teitel. We're an hour away from the opening trade here in Europe, and this is what you need to know. Asian stocks and gold trading close to record highs as US labour market data cements a September cut from the Fed. Bloomberg learns that OpenAI and Nvidia are expected to announce massive investments in the UK next week. We're going to have all the details of that story. Plus, US Treasury Secretary Scott Bessent flies to Madrid to meet Chinese Vice President Li-feng. This as momentum builds towards a Trump-Xi summit in October, Valerie.
Equity markets are looking positive to close out the week. The U.S. markets, the S&P 500 is on a 4-day winning streak, trading unchanged at the moment. Euro Stoxx 50 futures, though, in the green, up 0.3%. The euro holding on to gains of yesterday after the ECB decision was taken just slightly hawkish. And the U.S. 10-year yield trading above the four handle at 4.03 after briefly dipping below 4% after yesterday's data. The countdown to the opening trade starts right now.
Friday morning, good morning. Are Trump's tariffs costing Americans their jobs? That's one possibility, judging by the data we're seeing at the moment. When does bad news become good news? That's another key question that we need to be talking about as well. What's going to happen with the Fed next week? Is QE going to make a comeback? Is the flattener trade the one to be looking at? There's lots going on in terms of the bond market this morning. And the claims data, Valerie, stole the show yesterday.
Yeah, right. If you were staring at the CPI data, you were missing really where the action was. It wasn't jobless claims, surging to nearly a 4-year high, coming way higher than expected by 30,000. Yes, it does cover a U.S. holiday, but still coming in higher than expected. So you have to take that into account. And that really is what led the reaction in the market yesterday. We're seeing yields across the curve very close to 2025 lows as we speak.
Okay, so there's a couple of questions that come off that. One of which is, are tariffs costing Americans their jobs? Because if you look at the data, it's quite clear, and a trend is beginning to emerge that tariff sectors are being hit the hardest. When does that narrative start to play, and does it play in US politics? I don't know. There's a lot of other things going on in US politics right now. And the other thing is, this is bad news, but the market continues to take it as good news. When does bad news become bad news, I think, is a key question. When does the possibility of a kind of a real recession, which we haven't had for a decade, start to manifest itself in these markets?
Well, look, not yet. That's what the market is saying. This bad news on the labor market is just continuing to boost traders' expectations of Fed cuts. We're now fully pricing in 3 rate reductions by the end of the year from the Federal Reserve to be kicked off next week. The focus, though, yesterday was really about the back end. The back end rally. And we're seeing more and more comments from traders, from funds, talking about how they're less convinced about this steepening trade. Some very interesting lines from PIMCO saying the reason why is they think that a Trump-backed Fed is more likely to restart quantitative easing.
So here's my problem with that. I thought Bessent had a problem with QE. I thought the Treasury Secretary didn't like the fact that the Fed had done
that
QE.
Overused it.
Oh, they've overused it, but it's okay to use it in this. It's okay to use it in this situation. So that's going to be okay. But it's interesting that people are beginning to worry about what is going to happen at the long end of the bond market. If you take away Fed independence, if you basically cement in, which increasingly looks like it is, a 3% inflation target for the Fed, that's beginning to feel like a reality now, which I think is fascinating in terms of kind of where we are right now. Apologise for that. And we find ourselves in a situation where the back end of the bond market might have to react to that. But clearly, this administration is worried about the back end of the bond market and feels that it needs to do more along those lines. QE, maybe Operation Twist, maybe other things coming into the market?
I think before that narrative maybe steps to take a step further, we have to watch about what's going on when it comes to musical chairs at the Federal Reserve. We got some news overnight, one of which being about Lisa Cook. The Trump administration has asked the appeals court to pause the order allowing Lisa Cook to remain on as governor while the court weighs her decision. They want this answer from the appeals court by Monday. And then Stephen Miran, his Senate confirmation hearing, the big one, is scheduled for Monday night. Why is this timing important? The Fed decision begins Tuesday morning. The meeting of the Fed decision begins Tuesday.
So once they're in their chairs, we kind of done. Assuming they're both in their chairs, do we accept that? Does one have to leave halfway through? I don't know. I'm joking, but it is slightly ridiculous that this is the situation we find ourselves in. And how much could it change the debate? How much could it change the outcome of this meeting?
I think it would really depend on how Miran votes. Remember, we also get the summary of economic projections.
That's what I think
if he is a massive outlier in that, I think that is a big tell on where we're headed for the potential Fed chair candidate that we still have not heard yet from the Trump administration.
If he wants the job, right, isn't the first thing he does is go in there?
He's already working for the White House. He's just on a leave of absence.
I know, but if he wants the Fed job, the top Fed job, doesn't he just go, yeah, you guys are putting your dots up here, I'm going to put mine down here?
Surely there's a game to this, though. You need to start out sounding like you're credible if eventually you want to start taking political persuasion into account, right?
But what, credible with who? Credible with Trump?
With the markets or with the Trump administration? I mean, it's a fine line to do both those. Scott Bessent has done a good job about keeping those two lines as well.
The PIMCO story this morning is fascinating.
Exactly.
This is where we're going with this. This is where all of this is going, is PIMCO taking off the steepener trade because it's worried the fact that the administration is going to start messing with the yield curve. That is huge.
Well, remember, it was a few weeks ago that the Trump administration was floating about declaring housing an emergency. Yeah. That could possibly be an avenue at which they could relaunch QE, bring down long-end yields. That would perhaps help the mortgage market. I mean, that could be an avenue, another emergency for them to take that action.
And this takes me back to the stock market. So historically, the reaction in the stock market to anything that improves liquidity in the system, which basically what QE would be for stocks to shoot to the moon. Like they're already kind of halfway to the moon. They definitely would be pushed further along that line if we did do QE. So that's the logical thing. But if we don't get that, is there a point at which the bad news that I come back to are tariffs costing Americans their jobs narrative? If bad news starts to become bad news, that is bad for equities. Because at the moment we're in this kind of weird phase where bad news is good news for equities because they're not looking at the kind of the hit to earnings. They're looking at the hit to funding costs.
But, Guy, I think we start to change that reaction if we don't have a dovish Fed. But now that the door is really open for dovish Fed policy, I think that narrative shifting would be very far out.
Doesn't that get superseded at some point by the fact that there is a recession? Does a recession trump Fed cuts?
Well, that's why, I guess, that's the reason why Waller wants to be out there in front with Fed cuts in order to prevent further labor market weakening. But for sure, if we get multiple months of negative payrolls reports and what's confirming we're in a recession and that the Fed is behind the curve, that is something that will worry the equity market.
Okay. Finally, something that worries potentially the equity market. Let's talk a little bit about what is coming up. So it looks like the Treasury Secretary is on his way to Madrid. I think he's going to come to London after that. We've also got the Trump visit coming up next week. We'll talk about the AI story around that. But it looks like he's going to Madrid to meet with Li-feng, who is the Chinese vice premier. Now, you've already had a meeting with Hegseth, the defense secretary, and his opposite number. Rubio has also had a meeting. It looks like we're building up to some sort of Trump-Xi summit that is going to take place, we think, in October in South Korea. What is discussed there, I think, is really interesting because you've still got a lot of pressure being piled by the US administration on those that are doing business with China, relating to what is happening with the oil story, Russia. There's a lot going on here. So you do wonder what could be resolved at that meeting and what would change as a result of that meeting.
Well, both sides in those Hegseth and Rubio discussions called the talks constructive. So things are looking good for a potential face-to-face meeting between the two leaders. But we need to talk about deadlines here because the one that is coming up is the TikTok deadline on September 17th. The actual trade negotiation deadline extension doesn't hit until November 10th. So perhaps TikTok will be a big part of these discussions. Did you know that the White House recently relaunched their TikTok just a few weeks ago? So maybe that's showing us a signal about where this is going.
Are we going to have a Trump-Xi summit about TikTok? No, I find that very hard to believe.
Well, hopefully maybe they want to get that cleared up before announcing a face-to-face meeting later next month.
Okay. There appear to be bigger things, maybe, other than social media, maybe to worry about right now. Catherine Nice, PGIB's fixed income chief European economist, is going to be joining us shortly. We need to talk about the UK. We need to talk about what's happening with the ECB. Vincent Mortier, Amundi's CIO, is going to be joining us shortly as well. Not a fan of tech stocks in the United States. Coco Agbo-Bloua, SocGen's corporate and investment banking global head of economics, cross-asset and quant research. That is a business card. That's a very big business card. We'll see what it looks like a little bit later. I wonder if he's actually got one. I'm going to ask him about that.
Well, let's take a look at the risk events on the horizon. We have a few more ECB speakers this morning at 9 a.m. We hear from Olli Rehn speaking in Helsinki at 9:15. We hear from Nagel speaking in Frankfurt. We already got a few ECB speakers this morning. Villeroy saying another rate cut is possible in the coming meetings. Remember, he is a dove. We also heard from another ECB Governing Council member this morning teasing that the next move for the ECB still could be a hike rather than a cut. But later today at 3 p.m., the big data out of the U.S. is the UMich consumer sentiment. We'll have an eye on that and what it tells us about inflation expectations. And then after market close, the Fitch review of the sovereign debt of France. Remember, they are on negative watch, and the expectations are that they will likely get downgraded today.
OK, there's a couple of things to say about this, one of which is the Bank of France governor is currently, or just finished speaking to BFM Business, saying that France must and can tackle its budget problems. Another rate cut is possible in coming meetings. He also says, I wonder if those two things are related. The fact that France might need a rate cut from the EC, I don't know. I don't know whether the cost of money is actually the biggest factor right now for France. You could argue that maybe it would have an impact. But a downgrade today would be quite significant and would just reinforce once again the fact that France needs to sort itself out. And you do wonder whether we are ultimately heading towards fresh elections. It kind of feels increasingly likely that that is going to be the case. And how would the market react to that, I think? More political uncertainty in France, the possibility that actually you get a right-wing government in France. It's going to get really complicated. And today could actually be quite a big catalyst for that.
Yeah, we're still waiting for a session where those French 10-year yields close above Italy. It still hasn't happened. It's happening for session.
I think they're at the same level. I think tells you everything you need to know. What else do you need to know this Friday morning? Let's walk you through the news. The former Brazilian president, Jair Bolsanaro, has been sentenced to 27 years and 3 months in prison for plotting a coup after his 2022 election defeat. This makes Bolsonaro the first former president convicted of such a crime in the country. His lawyers are expected to appeal his sentence. Washington, and this is the critical bit, Washington has warned it will react, quote, accordingly to what the Trump administration has called a witch hunt. I would expect to hear from the President of the United States on this matter at some point today. The US federal investigators have released a surveillance video as the manhunt continues for the gunman in the killing of the conservative activist Charlie Kirk at a campus event in Utah. The state governor says he will be working with attorneys to pursue the death penalty in the case. And OpenAI says it's closer to converting into a more traditional for-profit company after extensive negotiations with its top shareholder, Microsoft. The deal would include offering the company's non-profit arm a stake in OpenAI of at least $100 billion, at roughly 20% of the total valuation. That would mean that the company would become effectively the biggest startup in the world. Microsoft shares rose in late trade after the announcement, which calmed investors' fears about a rift with OpenAI over the restructuring talks. And this takes us to the UK, where we are anticipating, Trump's going to be here next week, and normally he comes with an entourage. In that entourage, it seems, is going to be Nvidia, Sam Altman, Jensen Huang. We're expecting big announcements to come through in terms of investments in data centres in the UK. To be honest, the UK needs all the help it can get right now, so at least some positive news may be coming through for Keir Starmer.
Yeah, perhaps the Stargate project, it goes abroad for Sam Altman and OpenAI.
Well, it's already in the Gulf.
Any potential investment here in the UK would be dwarfed by their pledges already in the UAE and what they've done in the US. But it still could be instrumental for here in the UK, playing right into what Starmer says that they need is to turbocharge AI investment. But you have to think that Trump is maybe bringing these leaders to the UK and wanting something back out of it.
He always wants something. This is a very transactional relationship.
Exactly.
And what are we going to see in return? What is also interesting is that this is at a time when we're struggling here in the UK to keep companies in the pharma sector. And there's this whole debate about drug pricing. And I do wonder whether or not this is going to come up next week as well. The fact that Trump has crossed that Europe has lower drug pricing than we're seeing in the United States. And that could be quite a flashpoint, I wonder, given the NHS's struggles at the moment.
And then also we know Scott Bessent is going to be here. So it's going to be a huge team of delegations coming to the UK for meetings that'll take place most of next week. That'll be a huge part of our focus. Well, coming up on the show, we'll dig deeper into the tech story and hear from Bloomberg's exclusive interview with Google's DeepMind co-founder. Plus, we're looking ahead to Fitch's review view of France after a turbulent 2 weeks of politics for the country. But up next, bonds in focus as a Fed rate cut in September looks all but certain. We'll talk markets. If you have any questions for your own for our guests, please send them to us on IB plus BBTV Go. We'll have more on the markets next. This is Bloomberg.
President Donald Trump is reshaping the U.S. government from the inside out, and even the Federal Reserve is a target.
Jerome, too late?
That come too late, pal.
I think he's terrible.
Some very strong words coming from the president.
Termination cannot come fast enough.
People can say whatever they want, that's fine.
This is something different, and I worry about it.
The threats to Fed independence that we're seeing right now are real and they're significant.
They're under a white-hot political spotlight right now.
Overall pressure campaign.
The president and I are both concerned about the foundations of the Fed.
With the unprecedented attempt to dismiss a sitting governor,
Lisa Cook sues Trump over move to oust her,
and an economic ally poised to fill another vacancy.
If I'm confirmed to this role, I will act independently.
An institution traditionally sheltered from politics is having to navigate unfamiliar waters.
Names can change, but I think the ultimate point is you're really targeting the independence of the central bank.
Everybody agrees that central bank independence is critical.
Central bank independence, we have to fight for it.
Fed independence is the crucial underpinning of the Fed's credibility as an inflation fighter. If Fed independence is lost, that credibility is shattered.
We're never going to be influenced by any political pressure.
Oh, he'll leave. If I ask him to, he'll be out of there.
One of the biggest challenges is dealing with uncertainty. A central bank wants to avoid contributing to that uncertainty.
That was this week's documentary from Bloomberg Originals on Fed independence, or dependence, I guess you could probably now call it. You can find it online. You can go to the Bloomberg website. You can find it on the YouTube channel as well. It's worth watching. Pay attention. This is going to be an interesting few days, Valerie.
It's going to be an interesting few days because we have some more catalysts for Fed independence happening on Monday. Trump has pushed the appeals court to overturn Lisa Cook's ability to stay on as governor ahead of the central bank's decision this week. He wants that appeals court to make the decision by Monday. We also heard that Stephen Miran's Senate confirmation hearing will be put to the floor of the Senate on Monday evening. Now, all this is important when it comes to timing because the Fed's meeting starts on Tuesday morning with their decision released on Wednesday. Perhaps these worries about Fed independence is what the price of gold has been telling us lately. Yesterday, gold hit a new high when it comes to its inflation-adjusted measure, surpassing that high that it hit in the early 70s. We also heard from a few traders out there being very worried about holding on to steepening positions. One of those was PIMCO's CIO saying that they are less convinced of holding on to steepeners because a Trump-backed Fed, is more likely to open up the doors for quantitative easing. Guy?
It's amazing. That's the situation we now find ourselves with. Are we going to see significant changes to the shape of the U.S. curve? What is going to be the implication for the rest of the world? I want to talk as well about what is happening with the ECB overnight as well. We're getting fresh comments coming through from a number of members of the Governing Council. You got Kazakhs just speaking just a couple of moments ago. We're in a good place on inflation, apparently. We're going meeting by meeting. The Governor of the Bank of France taking a slightly more dovish stance. Vilroy talking about the fact that another rate cut could be possible. Let's fold all of this together. There's a lot going on. We need to fold in the UK data. We've just seen dropping onto our screens as well. Stagnant growth in the UK, judging by the GDP data month on month that has just hit the Bloomberg terminal. Catherine Nice, Chief European Economist at PGIM Fixed Income, joining us to talk about all of this. Catherine, let's start with the ECB. There seems to be some debate as to whether or not they're done. Are they done? Is the end of the cycle here, or do we have one more cut to go?
So it's an interesting contrast with what's going on in the U.S., certainly. What I would say is that they are not done. I do expect them to cut one more time, but not until around the second quarter of next year. Really just as we get into that period of significantly below target inflation that we're expecting, that 1.6, 1.7-ish kind of number, in order to kind of head off any chance that that gets entrenched. But other than that, I do think they're done. And this has really been our view since about a year ago.
Catherine, we're talking about the political influence that we're seeing in the United States on the Federal Reserve, which is obviously extreme. How much political influence is there on the ECB right now? France is a mess. Plenty of other countries are as well, but France is in focus right now. Is France going to be something that influences European policy? How bad would it have to be? What would a downgrade do today, for instance, from Fitch? How much is politics interfering in policy in Frankfurt?
Well, look, central banks are a delegated arm of the government. They are always accountable to elected leaders and are held to account and have to be very transparent and communicate their decisions. So there is always that aspect of the role. They are never completely insulated and isolated from what is going on. And the frameworks are never designed to be that, because everybody understands that they are a delegated arm of the government and therefore need to be accountable to the people that they serve and the elected leaders. That said, the ECB is famously probably the most independent central bank in the world. Their independence is enshrined in the treaty. It would require unanimity of the EU to change that. And so they are, and they have a single mandate of price stability. So this does give them sort of additional, if you like, protection in order to really focus on price stability. And we are seeing that now. I mean, the messaging from Lagarde's press conference yesterday, I thought, was on the side of being more hawkish. And, they see inflation essentially around 2% over the medium term. They've got growth at 1.3%. That's not too far from potential. And so no need to be adjusting rates aggressively in either direction.
Catherine, let's switch things up and talk about the UK. We've had some data drop just in the last 20 minutes saying that the UK economy has showed zero growth in the month of July. We had a commentator on last week saying that there'd be more fiscal credibility in the UK if actually the Treasury and the central bank were working more together in common goals. What do you think about that?
So it's completely natural that a central bank and the fiscal authority would be coordinated, but they do need to be setting policy in a way that is not seen as leveraging off the other, if you like. And I think that at this current juncture, particularly for the UK, anything that would give a hint to that would probably not be very well received by markets. I think right now markets will be more reassured by seeing a central bank that is really committed to getting inflation to 2%. And of course, that is in the best interest of the Treasury for fiscal reasons, because the sooner we can get back to 2%, the better. So I think any kind of sense that going beyond the normal coordination mechanism, that there's some sort of a backroom negotiations going on, I think would ultimately be counterproductive.
All right, that was Catherine Nice, the chief European economist at PGIM Fixed Income. Thanks for joining us this morning, Guy. I'm still wondered whether when you're talking about this bond market and talking about fiscal credibility, is it really more about what's going on the front end of the curve, or is it how the back end of the curve is trading recently? Back end of the curve probably tells you the story that you need to pay attention to. The UK would be a case in point as to where some sort of financial repression probably would solve a few problems. Maybe the Bank of England not doing QT right now might also solve a few problems as well. You wonder whether the pressure is going to be on that one. Coming up, we're going to speak to Vincent Mortier. He is the Chief Investment Officer at Amundi. Political impasse in France, one topic. What is happening in the bond market, another topic. Does he like US tech? Well, that's another topic. We have many topics to discuss.
Friday morning, 30 minutes to the final equity session of the week for European equities. The picture looks like this in terms of the futures narrative. We obviously are pricing in what happened yesterday in the United States. Expectations now almost concreted in. The foundations are firm when it comes to that Fed rate cut. US futures are fairly quiet this morning. European futures have got a little to price in. That's the narrative. Maybe a little bit of calm, maybe, before that Fed meeting comes next week.
Well, it looks like we're having a bit of calm, at least when it comes to European bond market. Fixed income opening up just a teeny bit softer across the curve. German 10-year yields are higher by less than a basis point. France 10-year yields at 3.45. Remember, we do have a Fitch review of the sovereign debt of France later this evening. They are on negative watch, so watch out for a French downgrade later tonight, but it doesn't seem to be spooking fixed income here in Europe just yet.
OK, let's turn to what is happening in France. France's new Prime Minister, Sébastien Lecornu, faces the need to quickly address concerns over the nation's debt and budget deficits. This, as Val mentions, Fitch Ratings preparing to pass judgment over the country's creditworthiness a little later on today. Joining us now, Vincent Mortier, CIO at Amundi. Walter, good morning. Thank you very much indeed for your time. What implication would there be of a French downgrade?
I mean, to be very frank, the market is already incorporating at least one or two or even three downgrades. So, I mean, for market action, it won't mean a lot. We are still far away from sub-investment grade ratings. And so if you look at the market has been, I would say, quicker than the rating agencies to adjust the levels. So for me, it's a kind of non-event, even though, of course, we need to monitor what will be the narratives and the outlook linked to any decision. But for me, as an investor, it's a non-event, to be clear.
Do you think the spread with Italy gets wider? Do you think that we're going to see the spread with Germany getting wider? What do you think the trade here is on OATs?
No. I mean, at current spread, it's very fairly priced. Whenever it is widening a little bit, we see some renewed interest to buy by many investors, by our clients. And if you look, I mean, today, the French 10-year yield is in fact lower than 1 week ago, for example. So I mean, the bond market is still very constructive. There is no panic at all, and I think at current spreads, it's fairly priced. So I mean, we will see buying interest from that levels.
Vincent, I'm interested to get your thoughts on the ECB after the decision yesterday was taking just slightly hawkish by the market. I read in your note that you are expecting 2 rate cuts this year from the ECB and are more dovish than expected, or more dovish than what the market is pricing based on your idea that the German spending won't boost inflation. Was there anything that Lagarde said yesterday that might change your opinion on those cuts?
Well, we have confirmed our view that we expect 2 more rate cuts, and actually our growth forecast for Europe are now quite a little bit below the ECB ones, which has been revised upwards yesterday. We continue to believe as well that the effects on the GDP growth of the German various plans will take many years to unfold. You mentioned France, which is low growth for quite some quarters to come. And so overall, we believe that European economy will continue to be weak. And in that context, we think as the ECB will have a renewed accommodative stance later this year or next year. And inflation is still under control and will continue to drift downwards. So all the elements will be in place to have another cut. And in particular, if the Fed is starting to cut. I mean, it will be also more comfortable for ECB to cut. So indeed, we are at odds with the consensus, but it's a very strong conviction we have on the euro curve.
So, Vincent, it sounds like that your idea that the Fed will resume their cutting cycle is, again, one of reasons why you think the ECB will have room. How aggressive do you think the Fed's cutting cycle will begin to be? The market is pricing in a 25 basis point rate cut, but are you expecting 75 by the end of the year? That's what the market is currently pricing.
Exactly. So we have been consistently this year in a camp of 3 cuts this year. while the consensus has been very volatile. The latest data on the job market is clearly indicating that there is room to cut. And we believe that the Fed will choose the job market against the inflation data. Inflation data in the US are not that good, even though we are no longer in extreme inflation, but nevertheless, we think inflation will be sticky at 3% for quite some time. But given the weaknesses of the job market and the first cracks we've seen in the economy, we believe the Fed will felt obliged to act with or without political pressure. And therefore, we are still expecting 3 cuts this year. And that's why as well on US rates and... sorry, yeah.
Sorry.
So we have a steepening position. Yeah.
Okay. It's interesting. Let's talk about that steepening position. You take me to where I want to go. Vincent, there's a story on the Bloomberg this morning talking about what PIMCO is doing. And PIMCO is taking potentially that steepening trade off because it believes that there is a growing possibility that the Trump administration will do something to flatten the curve. Now, that could be a change in the way that the US issues at the Treasury Department. It could be a Fed controlled by the White House doing QE again. The chatter is getting louder and louder that the US curve is going to steepen because that's what the US curve is going to flatten because that's what the US administration wants. What do you think about that?
Well, indeed, we have still, and we continue to believe in the steepening positions, but not on the same areas of the curve between US and Europe. So in US, we believe the curve is steepened from the short end, and while in Europe, we believe the curve will mainly steepen by the long end. But overall, I agree that the likelihood the Fed will try to control the curve, or the Treasury as well, with other kind of means, will be something that we will see. But nevertheless, there are many other reasons to believe that the long end of the curve in the US will at best be flattish or continue to drift upwards, while the short end will continue to go down. So that's why we are still, we maintain our steepening positions.
Okay. Final quick question from me. You're still cautious on US tech. This in a week where we've seen Oracle leaping 30% to the upside. How tempted are you to jump back into that trade? Why don't you like US tech at this position? Do you think that we are going to see some sort of a turnaround? Everybody's looking for potentially some kind of a crack in the tech story in the United States, but it's not there at the moment, and tech continues to go higher and higher.
Absolutely. It's a pain trade, to be frank, for us. The US market has been fully driven by tech. If you strip out the tech sector, the price-earning ratio of S&P is not far away from Europe, in fact. So it's really the tech sector which is driving totally the US markets. And here my issue is that there are massive investments financed by either equity or debt. And the market is only seeing positive news or speculating on positive outcome. And you mentioned Oracle, it's a good example. But Oracle is linked to one single client making a very huge investment in their products. And the question mark is how will this be financed? What is the business model around? And at the end of the day, I mean, AI is something important for sure. But there will be also pressure on margins. It will become more commoditized, and to believe that there will be only winners around all Americans, and that deserves such high valuations, is something that will prove probably wrong. The question mark is the timing. The market is still super momentum driven, lots of leverage plays. Every dip is bought. So it's not a question of when, if, but more when. So that's why we continue to keep this position in our books. But I agree that short term it has been somehow painful, even though I continue to believe it is the right thing to have, to be super selective on the tech names, because there will be a dispersion coming up to the upside and the downside.
All right, Vincent, so it's all a question of timing when it comes to tech. Vincent Mortier, CIO of Amundi, thank you for your thoughts. Well, over to the ECB. ECB Governing Council Palacides says that the central bank is in a comfortable position and has no need to lower rates further to deliver stable inflation. Take a listen to our interview.
The risks to inflation are balanced. Nonetheless, we do live in a world that is becoming all the more uncertain. So uncertainty is on the rise on many fronts. Geopolitical risks, trade tensions, and other developments across the globe. And therefore, even though we are saying that the risks are balanced, this is not a very strong argument to make because of the existence of these risks.
So with all of those risks in mind, is it sensible to keep your monetary powder dry?
It is sensible to keep our monetary policy dry, but at the end of the day, we do forecast, we do make our projections as needed, and we do expect that these things will play as per our projections.
So if you were to move again, would you need forecasts to vote to do that?
We would need additional information. There would have to be a significant difference in economic fundamentals, in economic projections, and other data. So yes, we would.
But to be clear, is October live? You could move without those projections?
One cannot preclude anything. Yes, we could move if the need arises, if there is an event in the economy that warrants a change in the interest rates.
That was the governor of the Central Bank of Cyprus there, speaking exclusively to our own Lizzie Burden in Frankfurt. Lizzie joins us now. Lizzie, so is it job done for the ECB? We heard him teasing there that perhaps the next move for the ECB could actually be higher in yields.
Exactly, Val, and we're getting some diverging views from Governing Council members post-meeting this morning. As you say, of course, they held rates. That was no surprise. But there was a red herring dropped yesterday in that they revised down the inflation forecast for 2027. And as you know, that is the crucial horizon for a central bank, the medium term, hence the drop in the euro off the back of the decision, because you had markets thinking maybe they want to keep an insurance cut in their back pocket. But then when President Lagarde was speaking in the press conference, she talked about how, once again, she said the euro area economy is in a good place, and she brushed off that revision. So we got some clarity there from the Cypriot central bank governor, as you heard, saying that the risks to inflation are balanced. He also said, as you say, that the next move could go either way. So a very assured view from him, in contrast to what we're hearing from the Bank of France governor, François Villeroy de Gallo, this morning, saying that another cut can't be ruled out. So there is a divergence of views on the Governing Council.
Talk to me about how the ECB is thinking about trade policy that we still don't know the full parameters of.
Exactly, because last week, Guy, we had that warning from President Trump that because of this antitrust fine that's being slapped on Google, he could still come out with more measures against the EU, even though Brussels and Washington have agreed this trade deal. It was interesting speaking to the Cypriot central bank governor about trade. He says, yes, they're relieved that there is a trade deal. It alleviates some of the uncertainty that perhaps is holding back businesses from investing. But any kind of protectionism is bad for the euro area economy, he says, and notably 15% tariffs are above that level that was in the base forecast from the ECB at the last projection. Also, we have to think about the imported risk from this euro rally, and just interesting to note the comments coming through from Šimkus, the Lithuanian Governing Council member this morning, warning that a euro rally will have a negative impact on price growth. We knew that, but the more this divergence opens up between the ECB and the Fed, the more the euro climbs towards $1.20, the bigger an issue that's going to be.
Lizzie, it turns out there was things that were worth paying attention to out of this meeting.
Told you.
Completely boring. Lizzie Burden, thank you very much indeed. Lizzie in Frankfurt. She'll be back in London next week. Coming up, Sabadell's board has rejected BBVA's $18 billion bid, calling the offer price too low. We're going to talk about that and the other stocks you need to be paying attention to this Friday morning. The Open is 14 minutes away. This is Bloomberg.
Well, less than 12 minutes to go from the opening trade here in Europe, and the futures picture is looking broadly positive. Euro Stoxx 50 futures are up near 0.2%. Over on Wall Street, though, we're tracking in the red. S&P 500 futures are down 0.1%, but that came after quite a strong week for equity markets on both sides of the Atlantic, and a strong week for the bond market. Joining us now to discuss markets is Bloomberg's executive editor for Asia markets, Paul Dobson. U.S. Treasuries 10-year going sub 4% in the session yesterday. Is this bond rally going to continue?
Yeah, well, interesting. I mean, you've got to start asking yourself how much further can it go based on, the outlook for the economy, the outlook for inflation, and so on and so forth. I think particularly interesting, look at that 5s, 30s curve, How much lower can short-term yields go? We're already pricing in something like 6 cuts by the end of next year. Will the Fed go any further than that? It would be quite aggressive. And if not, then perhaps, that sort of puts a little bit of a floor under the short-term yields. And what we've seen, I think, quite recently, interestingly, in the last couple of weeks, is actually that the curve has started to flatten a little bit. The 30-year has been coming down a little bit further. There was pretty decent demand at the auction yesterday. I think that spread got to 120 basis points. It's now back around 100. We've got PIMCO saying, maybe that trade has gone far enough for now. It's performed really strongly. And so, perhaps the back end of the yield curve can perform a little bit stronger, but short-term interest rates going to stay a little bit more rigid from here. We've been debating why PIMCO are doing that, which is an interesting debate, but we can't go down that rabbit hole right now. At the moment, you've got a bid on bonds and you've got a bid on equities. There's a possibility of a US recession. The labour market is weakening, I understand. And you've basically got bad news being good news. The Fed's going to cut rates. It's all good. How long does that narrative get maintained for? So interesting, isn't it? But it's still going, right? All around the world, we've got Asia getting close to a record high. Have a look at the industrial metals there. Performing well, about to have a bit of a breakout on copper by the looks of things as well. Some interest going on there. So it all projects that kind of economic strength. And the people that I'm talking to around the city this week are sort of saying, there's still lots of cash to be allocated. People want to buy US equities. They want to buy European equities. They want to buy emerging market equities. They want to buy everything. Do they want to buy it? They want to buy bonds. They don't mind buying bonds. They want to buy liquid alternatives. They're happy buying pretty much everything. Maybe not US Treasuries. There's cash to be deployed, basically. Next segment about the economy, which is kind of strange, given what you said about the outlook and the slowdown and stuff like that. But for now, the music is still playing. People are still drinking from the punch bowl.
Drinking from the punch bowl, right. I want to just mention that, we're having these all-time highs in stocks happen alongside nearly all-time highs if you're looking at inflation-adjusted gold. Surely that is telling you something to worry about.
Well, I think that tells you people are a bit worried about currencies in general and the debasement of currencies, and so people like gold as an alternative. Yes, it's been performing very strongly. There's central banks are buying. There's limited supply out there, and people are using it as a little bit of a protection in case of anything else out there. And like I said, there's lots of money to deploy. People are liking to put it in all different ways. But if you think that the dollar is going to weaken, or you think that your domestic currency is going to weaken, then maybe you don't want to hold that so much relative to gold. Okay. Paul, it's been great to have you in London this week. Thank you very much indeed for joining us. Any takeaways from London apart from the fact that you can't get anywhere? Can't get anywhere. Rains a lot. No, I was out and about yesterday in the evening. I've been surprised at how resilient the city is, how many people managed to make it in. And I think that speaks to, at least in the city, the people are happy. The streets were busy. People, a lot of bikes around. Yeah. But so there's that at least. I mean, obviously, industrial production numbers today didn't look as rosy. Don't do that. Don't know. It's Friday. We're not going to pour any rain on this parade. Paul Dobson, very nice to see you. Thank you very much indeed. Plenty of stocks that we need to be watching. Spanish banks in focus for Louise Moon.
Exactly. Spanish banks, a big story today. So Sabadell has rejected an $18 billion bid by BBVA, essentially saying it's insufficient and doesn't value it high enough. So offer price doesn't adequately reflect the value of Sabadell's shares. So BBVA now have until October 7th to make a final bid, if they are to. So we'll have to see how that one plays out. Both have been performing well so far this year, so we'll be watching those closely at open. A big potential merger, if that goes through, between two Spanish banks. The next one we're looking at is ASML. So OpenAI and Nvidia have both pledged, or both planning to pledge, billions of dollars into UK data centres. Now, this, while that would be a boost for the UK, BI have a report that this could also benefit ASML, listed in Amsterdam, saying that they calculate up to 25% of investment into ASML as a result of that. Now, they've had a bit of a rocky year, only slightly down so far this year. There's been a lot of news to do with tariffs, been reacting quite heavily to that, so we'll have to see how that reacts at open and if this might provide some sort of boost. And then finally, we are looking at RyanAir. So there was a report overnight saying that RyanAir planned to cut another 1 million seats to Spain. A nice, colourful quote, as always, from Michael O'Leary, the CEO, saying if costs in Spain are too high, we'll fly elsewhere. So they're cutting those flights. That's on top of earlier cuts that they already have done to their winter capacity. This is all over higher taxes from the airport operators. Performing well so far this year. That they did have a bit of a drop when they cut that winter capacity, so we'll have to see if that happens again and if this plays through at open this morning. So that's the last one that we're looking at today.
Well, thanks to our equities reporter Louise Moon running us through the stocks to watch just ahead of the European cash equity trade. We were just talking about the buzz in the city that's been going on, and I'm wondering if it has to do with the buzz of the Lime bikes.
They do make a slight buzz when they go past, I have to say, because usually they overtake me, because I ride a slower, heavier, much slower, heavier Santander bike sometimes.
Nice dorky helmet, I have to say.
Nice dorky helmet. Valerie saw me on her way home the other day. Yes, no headphones for me. Anyway, look, that's the live picture. Just one Lime bike. The tube strike ends at 8. This is Bloomberg. Friday morning, good morning. Stocks went higher in Europe yesterday. Overnight, Asian stocks are close to fresh records. In the United States, it's a similar kind of picture. I'm not sure this is news anymore. Are fresh record highs on a daily basis news? I don't know. Seems to be that that's the narrative, though, that we are working with. Today, US futures are a little softer. Yesterday, this is where Europe went out. That's where the American market closed at the end of the day. I'm not sure there's actually much read across into the futures. Let me show you what we are looking at in futures this morning. Mildly positive as we continue this march ever higher in global stocks. Euro stocks 50 futures up by 1/10 of 1%. FTSE's up by 2/10 of 1%. Keep an eye on what's happening with oil stocks today. CAC futures, remember we have the Fitch rating review coming at the end of the day. Fairly flat today. There's some interesting things happening in the luxury sector. We'll come back and talk to Andrea Felsted a little bit later on about what is happening with Armani. So there's plenty of things going on. Stocks just keep going higher, Val.
Well, there's a few single name stories we have our eye on. One of them, as you mentioned, is the luxury sector after Armani has named LVMH and L'Oreal as among the preferred buyers for a stake in the company. We also have our eye on Spanish banks. This comes after a key Sabadell investor says BBVA's bid is too low. So we'll have an eye on the Spanish banking sector as well. And lastly, RyanAir, one of the biggest listed airlines in Europe. There was an FT report that they plan to cut 1 million seats from its Spanish flights next summer. So those are the key themes we'll be watching out for. I'll also have my eye on Tech Guy after Oracle was down 6% in yesterday's trade. Maybe some air comes out of that trade.
Yeah, just a little bit. Just a little bit after that massive rally that we saw earlier on this week. Michael O'Leary picking more fights with European governments. Shocker. OK, let's talk about what is happening with this market. Here we go. Time for the opening trade this Friday morning. We're expecting a mildly positive start to the session. There's a few interesting stock stories that you want to pay attention to. Feels like it's going to be some of the macro data, some of the geopolitics next week that may drive the narrative. We're obviously moving into that Fed rate cut, but we already know that's going to happen. That's not news, is it? FTSE 100, absolutely flat. IBEX, marginally moving on Spanish banks, maybe. We'll get back to that story in just a moment. Stock 600 going nowhere in a hurry. It's been frenetic this week. and maybe actually we are deserving of a day that maybe is a little bit calmer. The CAC 40 is up by 0.1%. FTSE 100 now climbing a little bit as well. We'll dig into the details in just a moment as to what is happening here as we await the DAX and the SMI. Their opening will come shortly. Val, what are we seeing when it comes to the sector story?
Well, in the sector's picture in the first few minutes of trade, we've got 13 in the green, the remaining 7 in the red. Basic Resources is at the top of the basket this morning. That sector is up over 1%. Seems like that rise in gold prices still helping some of the miners here in Europe. The energy sector is at the bottom of the basket, and I have my eye on the luxury space, looking for any reaction. I don't see any so far to these names floated by the Armani family as key to the preferred stake in Armani, but we have an eye on our luxury sector as it's opening up.
OK, we'll keep an eye on that. Yeah, look, oil stocks are lower. You've got Shell and BP, two of the biggest drops that we're seeing on the market this morning. Shell is down by 0.5%, but obviously it's heavily weighted, so that is dragging the story down. Novartis is a little bit softer. Banks and tech look like they're on the front foot. SAP recovering a little bit this morning. It is the second biggest weight on the upside. We've also got ASML rising as well. UBS is the biggest gainer, but as you say, there are some mining names that are on the upside too. So you've got names like Anglo American and Rio Tinto climbing quite nicely. So quite a big kind of position difference in what is happening in the industrial metals. We were just mentioning that just a moment ago, and what is happening with oil. We did see IEA just basically confirming this glut story that we have in the oil market at the moment. Are we going to push into the 50s on oil? I think that remains a key question for markets like London. But balanced today by a much more positive picture coming out of the mining market.
Yeah, at least when it comes to the Spanish banking sector, just a minor move into the downside from Banco Sabadell, down less than 0.2%. BBVA, on the other hand, down 0.2% as well. So that story about the bid not being high enough, not seeming to rattle the market so far as well. But looking for RyanAir, if the stock's not open yet, seeing if that noise about their pulling back on Spanish flights has anything to do with the market move.
We'll get some more details on that. Yeah, we'll come back to RyanAir in just a moment. Is bad news good news? Kirk Agbo-Bloua, Global Head of Economics and Cross-Asset and Quant Research at SocGen Corporate Investment Banking, joining us now around the table. Good morning.
Good morning.
We have bad news coming out of the US labour market. Is that good news for equities?
Yes, when it comes to interest rate, it is. One of the things we've seen is that the Fed has clearly increased interest rate quite massively after COVID because of what I call the original sin, where government and central banks spent $25 trillion to save human lives. And now that inflation is going back closer to normal, so it's all a question of what's neutral interest rate ought to be. So in the US, it should be between 3 and 3.5%. Interest rate went from 0.5 to 5.5 at the peak. They've cut by 100 basis points. The market is expecting another 140 basis points to reach terminal. So ultimately, what it means for corporates is that the discount rate and the equity return should come down. And this is what we're seeing, where the rally is no longer about tech. It is broadening. So we see small cap benefiting as well from that.
And no recession. No risk of recession here.
No, the risks of recession are pretty remote. Because because what's important is that if you keep interest rate too high, then you sort of increase the risk of recession. Because of it will essentially reduce the potential growth of the economy. So what the Fed is doing is adjusting dynamically the level of interest rate to make sure it can meet its dual mandate of maximum employment and price stability.
So when we're talking about the Fed, I think one of the risks on the horizon is potential dent to Fed independence. Is that something that worries you or comforts you?
Well, I think there's been a lot that's been written about this, and we don't think that we will have a repeat of the last time we had Fed independence being challenged by a president was the Arthur Burns era with Richard Nixon, who famously cared more about employment than he cared about inflation, and that led to the high inflation in the 70s. So today we have 12 members, voting members, 7 of which are the governors who are elected for essentially selected for 14 years, and then 5 of the 12 are the part of the 12 regional banks. So the challenge is that all of the 12 will be reappointed or their mandate expire in February 2026, and Lisa Cook, if she's replaced, will essentially mean 4 out of the 7 were selected by Trump. So the point is, even if you have control of the board of governors, they have veto rights on the regional presidents. So hence the argument that if they are actively vetoing whoever is not a dovish president, then they could have control. So it's not because you're being selected by Trump that all of a sudden that his president and governors will essentially decline to meet their fiduciary duty. And there have been mechanisms that were put in place since the Archer-Burn era to prevent the independence being a challenge. So ultimately, I think they'll still look to do what matters most for the economy as opposed to be extra dovish, which is the concern for investors. But I think this is a bit too much of a concern.
Yeah, well, I guess when it comes to what matters most for the economy, I mean, you can definitely argue that the Fed and this inflation targeting, this 2% inflation, it's been missing for 53 straight months. Is the market, regardless of the Fed independence question, is the market really going to start to question whether that 2% target is really valid anymore?
I don't think it would. It's a question that a lot of investors have talked about post the COVID era. So the consensus is clearly that we're not going to go back to the pre-COVID era that fast. But the 2% target is one of the only thing the major central banks across the world have agreed on, and this has worked quite well over the past few decades. So I think what's going on is a prudent measure of balancing price pressure and unemployment. So today the Fed is clearly pivoting from concern about inflation, tariff, etc., to the weakness in the job market. But one thing I also want to highlight is that we've been fooled by randomness for the past couple of years. In August last year, we were expecting a recession, and then the data changed. One of the things we realized is that the non-farm payroll, for example, is a statistics. So it's supposed to be looked at within a 95% confidence interval, plus minus 100,000 jobs. But the market is excessively focused on one number and a tiny change, which, again, is an estimate. So if you look at the average over time, unemployment rate claims, they are weak, but not necessarily. It's not because you have two data points that you can put a straight line and assume the third data point will be on that line. So we need to be careful on how we look at economic statistics, which have been incredibly volatile since COVID, working from home, some statistical adjustments are creating more noise. So the picture is not as bad as it looks.
Okay. We can debate the veracity of the data and what is happening with the US economy probably for quite a long time, and many people are. The picture you paint is one of asset price inflation. Is that the correct assumption?
Yeah, but I think it's more of a earnings boom. So what has happened post-COVID, we had two things. Number one, we had greedflation. This was the environment where companies were able to raise prices by more than their input costs. So profit margin went through the roof, and this is why a lot of economists and market participants got it wrong, expecting a recession when rates went up. What happened was that companies made a lot more money than that was expected, and net interest margin also went down because the excess cash was put in money market funds, earning 5.5% in dollars, which was offsetting the cheap financing they got post-COVID. So what's happening is companies were able to deleverage their balance sheet. I call this the vaccination of zombies, which is a theme we talked about in 2019. So that's no longer a problem. So household and corporate balance sheet were saved, so to speak, by the weakening of government balance sheet. And now we have this third industrial revolution around AI, which is not just one company. It's a whole supply chain and sectors. You mentioned Oracle. And I think this is just the beginning. It's sort of an S-curve in terms of adoption rate and investment required.
So asset price inflation.
Asset price inflation, but it has a sort of a semantic feel that sounds negative when you say asset price inflation. Because
it's bullish, guys.
Asset price inflation. So are assets going up in value? So they just continue to go up in value?
Because
there's not go up.
They go up in value because of the earnings that is justifying this asset price inflation. So in other words,
this is a fundamentally driven market.
Absolutely. As opposed to the argument around the dot-com bubble, things are going up for no reasons, etc. Because the risk premium on US assets should be higher.
Oracle going up 30% in one day is fundamentally driven.
Well, because they beat numbers and estimates. Nvidia is at $4.7 trillion in market cap, which is pretty much the equivalent of the entire Eurostoxx 50. And they're doing $60 billion share buyback. Their sales are up 50% quarter on quarter. So, I mean, it is an amazing earnings explosion that we see in the US.
Coco, nice to see you. Thank you very much indeed for seeing us. Coco Agbo-Bloua, Global Head of Economics across Asset and Quant Research. at SocGen Corporate and Investment Banking. Let's talk about some of the stocks we're watching this morning. Novartis is under a little bit of pressure. Let me show you what is happening in the pharma space. This is the picture on the stock 600, as you can see. We've got actually a reversal of what we saw yesterday. Novo is up, but the rest of the sector is down. LVMH is actually not moving on this story we focused on yesterday. Big move yesterday. Defence stocks stable today. Tech's up a little bit. Nestle's a little softer. Let's talk about what is happening within the pharma sector. Louise Moon has more details.
Yeah, starting off with Novartis, the Swiss pharma giant. Their shares getting weighed on this morning, down over 2% into the red. That's after they were cut down to a sell at Goldman. So if you look at the analyst ratings, most are for a hold, and their shares have been under a bit of pressure recently, so down further into the red this morning. Next up, we're looking at Hanover Reinsurance. That's the German company. Also a change in rating for them. They're up into the green, almost higher, about 2%. That's after UBS rated them as a buy, adding to about 13 analyst buys. So the majority of people really saying that they should be a buy, up almost 2% into the green, so a good start for them this morning at open. Next up, looking at RyanAir, the budget airline, just slightly higher into the green. That's after they said they were going to cut 1 million more flights to Spain. But doesn't seem to be weighing on them this morning. They're still into the green, but only slightly there. And then finally ending on Ocado. So news that one of their customers is looking at doing direct deliveries from their own stores, so not using Ocado's fulfillment centres. And that is really weighing on them, down over 8%, almost 9% into the red, so potentially losing out on a lot of business there.
OK. Louise, thank you very much indeed. Louise Moon, our UK breaking news editor. Mining stocks are actually having a fairly good day, but that's the kind of derivative trade of what we're seeing in terms of some of the metals prices this morning. Copper is up by 0.5%. Nickel is up by 1.45%. Iron ore actually fairly flat, but has had a really good run. Steel rebar is up. You've got gold also tracking higher as well. Silver's up even more. So miners generally across the piece this morning are doing quite well, which is a little counterweight to some of the oil weakness.
Well, it comes as, you know, yesterday that we saw that inflation-adjusted gold surpassed its 70s peak. We just had Coco Agbo-Bloua on here talking about this asset price inflation. I mean, gold's got to be where you hide out rather than equities. What do we think?
I don't know. It depends why you're buying gold. The juxtaposition of NASDAQ at record highs and gold at record highs, there's something odd about that.
Fed's not even doing QE yet.
I know, precisely. So kind of, but that's what makes it logical in some ways. If you believe that the Fed's going to do QE, right? Yeah. So that would pump more liquidity into the system, which keeps the equity train on the track, which pushes asset prices of tech stocks higher and higher and higher. And then you worry about what is happening in terms of what is the safe asset, which makes you buy gold. So in some ways, if you believe that the Fed is going to do QE and we're going to see financial repression coming through, then it makes sense. But that's the scenario in which it makes sense. And that's a really odd scenario to find yourself in, that you are worried about debasement of currency, you're worried about that whole side of things, so you hold gold.
Or is it a bullish asset price inflation, as we were just told?
No, but it is
a positive earnings boom.
No, but it's bullish if you believe that equity markets go higher in that kind of scenario. Mm-hmm. But the PPI data speaks to the idea that actually margins are being squeezed. So is that good for earnings?
Well, tech margins? That's what matters for the S&P.
Well, the Oracle story is basically based on, we'll talk about this a little bit later, the Oracle story is basically based on the idea that a number of the LLMs are going to continue to spend at the rate that they are at the moment, but the cash burn is phenomenal. So can they continue to burn cash? Maybe actually the way that you do that is by lowering interest rates and making it easier to maybe burn some of that. You can
Sounds
go
juicy.
round in circles. Sounds juicy, says Val.
Well, coming up on the show, Banco Sabadell has again rebuffed an $18 billion bid from BBVA. We'll talk Spanish banks next. This is Bloomberg.
Welcome back. 17 minutes into the Friday session. What is it looking like out there? Generally reasonably well bid. You've got the Euro Stoxx 50 up this morning, though it's interesting to see kind of what is happening in terms of the mix there. Actually, it's not up by as much as it was just a few minutes ago. We're now only up by 0.1%. A little fade coming through. The IBEX is actually negative, which is interesting, which takes us to our next story. Banco Sabadell's board has again rejected BBVA's $18 billion takeover bid as insufficient. This raises, of course, pressure on BBVA to improve the offer. How do you do that? Well, let's find out. We are joined in London by Bloomberg's Madrid Bureau Chief, Rodrigo Orihuela. Good morning. Nice to see you in London.
Yeah, nice to be here.
More cash required?
That is what everybody feels, except one person, and that's the chairman of BBVA, who's dead set, and he's saying there's no way he will increase it. There's some questions about that, because why wouldn't he increase it after spending over a year trying to buy this company? It's not the first time they tried to buy this bank, so it doesn't make much sense. And if he is so convinced that this is the future of BBVA, why wouldn't he do it? The second element, which is a slightly minor one, but really matters, their key advisor is JP Morgan. JP Morgan was also an advisor to Montepaschi. Montepaschi kept on increasing their offer till the very, very last minute to buy Mediobanca in Italy. So they have an advisor who's already worked on a very similar process and worked on the winner in that case.
OK, so just before Val jumps in, why does he not want to put more cash on the table? Why is he the only... has he given any indication as to why he doesn't want to do this? Because presumably the advice is from the... Put more, why? Why won't he do it?
I mean, the exact answer to that is because he says that this is the perfect offer. This is everything that matters. They have taken everything into consideration.
Yeah, from his point of view.
Exactly. And that there's nothing that justifies it. If you look at the numbers, what he points to is that when they started this process, the premium was about 42%. Yeah. Now it's about 10%. The premium, the negative premium in this case. And so he's like, it was a very good offer, and since then Sabadell has rallied because of the offer and not because of fundamentals.
Okay. Well, in that case, why does BBVA need Banco Sabadell? What is going to keep this deal floating and alive?
So the main reason they want it is because they are heavily biased towards emerging markets. About 50% of their income comes from Mexico. And so they would like to have much more exposure to Europe, but specifically to the only country they operate in Europe, which is Spain. And they say there is a lot of scope to consolidate the Spanish market. That would make them a more developed market bank.
Rodrigo, we're going to leave it there. Nice to see you.
Thanks
very much indeed for stopping by to see us. Nice to see you in London, by the way. We've spoken many times. I've never met you in person.
Go back to the sun
now. Precisely. Yeah, it's going to be sunny at least a little bit this weekend. Rodrigo Orihuela, thank you very much indeed.
Well, Bloomberg has learned that Giorgio Armani has left the entirety of his closely held company to his foundation, family members, and longtime aide Leo Dell'Orco, who will oversee the Italian fashion house following the death of his namesake founder. Armani will also set up conditions for the foundation to sell an initial stake of 15% in the company to LVMH, EssilorLuxottica, L'Oreal, or another company of similar standing within 18 months. Joining us now for more is Andrea Felstead from Bloomberg Opinion. Tell us about these potential suitors.
Well, the main thing to remember is that these assets, these well-known assets in luxury, come up very rarely. And once somebody gets their hands on them, they very rarely come up again. So that's the background. So everybody will be looking at this. You know, Armani's a very, very well-known name. It's a tremendous brand. A lot of people will be looking to get their hands on it. LVMH is interesting, always seen as a long-term developer of brands, a safe pair of hands. Essilor's got the license for the eyewear, L'Oreal similarly the beauty. LVMH is probably the only one that can do this, given the scale and the fact that the Armani brand...
How much will it cost?
I reckon it's going to be around 10 billion euros.
Will they need debt funding for this?
They would, but remember they bought Tiffany for $16 billion. I can't remember if that was dollars or euros. It was a long time ago. I think it was dollars. They've paid most of that back already. I mean, conditions are tough in luxury, but LVMH has a very strong balance sheet. It could definitely do it. Now, you've got to buy it. It also needs a lot of work. You know, it's very focused. It's got a lot of sub-brands, very focused on apparel. The real profit drivers are leather goods. But there's tremendous opportunity. The beauty, the eyewear. He's been very clever. He moved into hospitality before anybody else. Amazing opportunities, hotels, restaurants, which is where the future of luxury is going. So this really sets up a battle for this stake if it comes to pass.
And this is just for a 15% stake.
Exactly.
What's going on with the rest of the brand?
Well, I mean, we've got Kering's deal with Valentino maybe as a bit of a model because they've bought an initial 30% stake with the option to buy more. So what I would imagine happening is someone takes an initial 15% stake with the option to buy more over time. And ultimately, it's going to come down to how it performs because... You know, if Armani does struggle, and we think about Armani's challenges, if it does struggle, then they could sell more over time. It's going to have a creative transition. It's going to have to, you know, improve the business a bit. It's going to be hard work. So you could see an initial stake and then more being sold over time.
Why is luxury struggling when stock markets are doing so well?
Well,
crypto's doing so well as well. A lot of things are doing very well.
Yeah, exactly. Well, I've been quite vocal all year saying that actually I don't think it's as bad as the market is saying. China is clearly under pressure. China doesn't seem to be getting any worse. The US, there was lots of fear about tariffs and the impact that would have. I mean, we haven't really seen, you know, the impact of tariffs is probably really only coming in now for consumer stocks. But markets are back and crypto's back, and that correlates well with luxury demand. So we've seen quite a lot of brokers lately getting a bit more positive on luxury. I've been positive on luxury all year, really, because you know...
That's just the default position, though, I'm assuming.
Yeah, personally and professionally. But no, I don't think it is as bad as people just because of the reasons you've said. And I don't think luxury is... You know, there's a lot of talk about luxury fatigue and people being fed up with luxury. I don't believe that. I think,
you know,
well, it seems to be. Don't forget, we've got a big fashion week coming up as well. This fashion week is going to be very important. All the new designers are coming in. The industry's looking at that for, you know, to really spark excitement and interest again. There's been an awful lot of work going on to try to get people interested again. It's not going to be immediate, but I think there's a good chance.
Well, given luxury has been through a lot of upheavals this year, is there something within the Armani portfolio that these suitors really want to get their hands on? Is there something that really stands out for them?
It's really the brand. You know, it's a household name. Everybody knows. You know, we've just seen, you know, the outpouring of love after his death. You know, everyone knows this brand, and that's really it. These names come up so rarely, and when they do, everybody wants to get their hands on them. And also, there's not many things. If you're LVMH, there's not many things.
Not much left to buy.
And not many things are going to be big enough to make a difference. Yeah. Whereas Armani's a big name, big enough to make a difference. LVMH strength really is leather goods. A lot of potential in leather goods and in hospitality.
OK. It's New York Fashion Week this weekend, isn't it?
That's right, yes.
Are you going?
Yes.
Getting on a plane?
No. I go to the London shows, but no.
Maybe you have to report on it.
Not important enough to get invited to the shows.
I am certain that is not true. So asset price inflation, there you go. But this is the interesting
luxury
bit.
handbags.
But this is the interesting stuff. The stock market cannot stop going higher because it drives luxury consumption. The highest proportion of society has the highest... they're consuming a lot in the States. If the stock market rolls over, that rolls over, and then potentially you've got quite a big problem in terms of consumption.
Maybe they should wait a while before buying the name, because it'll be maybe cheaper if the US enters a recession.
Did you just sound bearish? I can't believe... No, that's not true. That is not happening. Valerie, bearish? No. Andrea, thank you very much indeed. Coming up, we're going to talk tech. That's next. This is Bloomberg.
Welcome back to the opening trade. We're 30 minutes into today's cash equity session, and it's looking fairly positive, though we are losing a bit of momentum. Euro stocks 600 just flipped to unchanged. So did the CAC 40, just briefly now in to the red. The FTSE 100 is outperforming this morning. That's off the back of some of these mining stocks doing well with the recent highs in gold prices. The DAX in the green, up 0.1% as well.
Okay, let's look at some market internals, figure out what is happening there. We're going to change the volume for next week. 100-day moving average captures some of the volatility we saw around some of the Trump tariffs, we're a little light. I think the baseline on this is probably minus 20. I think we're minus 40, so we are a little light on the volume picture this morning. Higher 336, lower 235. As Valerie was mentioning, the 52-week highs. There's a few of them are out there today. There's lots in the banking sector. There's a few in the defence sector. I think Rolls is hitting a 52-week high again today. But the bulk of them this morning come from the mining sector. This is partly down to gold. We've been talking a lot about Fresnillo recently. It is up another 4.5% today, hitting a fresh 52-week high. Seems to be on a daily basis that we see that story. But you've also got some of the industrial metals doing better right now. So names that are associated with copper doing a little bit better. Copper's up. Antofagasta is up by 2.2%. Anglo-American's up 1.1%. The industrial metal story is gaining some traction, and some of the London listing stocks, as a result, are responding to that, Valerie.
Well, here's what else you need to know this morning. Brazil's Supreme Court has sentenced former leader Jair Bolsanaro to a 27-year prison sentence for plotting a coup after his 2022 election defeat. The indictment was decided on Thursday by a panel of 5 justices who oversaw the case. U.S. President Donald Trump said the ruling was surprising and bad for Brazil. U.S. Treasury Secretary Scott Bessent will meet China's vice premier in Madrid next week. The two are set to talk national security issues, tariffs, and TikTok's status in the United States. The discussions come amid a flurry of diplomatic outreach this week, potentially smoothing a path for a future meeting between Donald Trump and Xi Jinping. And lastly, Bloomberg has learned that the leaders of OpenAI and Nvidia plan to pledge billions of dollars in support for UK data center investments. This is as UK tech executives join President Trump on his state visit next week. Sources say the two companies are teaming up with London-based data center business Nscale. Guy?
Finally, some good news coming through for the Prime Minister. We'll see whether that good news materialises next week. This in a week we've seen, obviously, a lot of problems for Keir Starmer, and also some fairly significant news when it comes to the life sciences sector, where we've seen Merck, for instance, throwing a lot of mud at the UK government for its attitude towards drug pricing, amongst other things. I do wonder whether some of that is going to change. But there's been plenty of big tech news out this week as well. We've obviously focused on what has been happening with the Oracle news. At the end of the week, we'll come back to this in a minute, Val, just talking a little bit about Oracle. How solid is the foundations of some of the rally that we've seen in the tech story this week? Are we going to continue to see? We talk about the UK investment that we're seeing from OpenAI. Is OpenAI, given the cash burn at the moment, going to be able to continue to spend that kind of money? It's interesting to see the Microsoft deal potentially being transacted, allowing that company to move into a for-profit format. But at some point, does that relationship change again? If we do see OpenAI running into problems, are we going to see Microsoft, for instance, taking a bigger stake in that business? There's a lot of questions out there at the moment. Let's carry on the conversation. Tom's just sat down. We were wondering where he was, but we found him now, so he joins us. You've been spending a lot of time talking to a lot of people about this kind of trade this week, and I'd be interested to get your take at the end of the week on what it looks like and whether or not the foundations of the AI story are more solid now than they were at the beginning of the week.
I think it's two really interesting stories, which are Adobe on one end and Oracle on the other. So Oracle, of course, with that really significant upgrade to the outlook on the data center and that pipeline of almost $1 trillion US. I mean, just remarkable. If they can deliver on that, that's another question, and the cost to deliver on that is going to be significant. But, of course, you saw that historical jump for the Oracle stock price on that. So that's one part of the ecosystem that I think stood out. The other part was Adobe, which actually surprised, obviously, to the upside, because this is a company that struggled, and what they've been able to show with the results that came through last night was that actually they are able to incorporate AI into their software and their platforms, and they are now finally starting to gain traction with customers. They have to make that a sustainable proposition. But for me, that was an interesting takeaway in terms of the momentum that still exists in the AI theme. And then, of course, we look ahead to the spend around data centers that could come through from OpenAI and Nvidia committed to the UK next week.
Yeah, what's your read on that? Is this just part of the Trump administration's visit, wanting to pledge help for the UK's attempt to become more of an AI centre?
Look, the Prime Minister Keir Starmer, he's really lent into AI. They've really shifted the focus from the previous UK government, which was focused on safety, much more to kind of delivering and needing to generate growth on that. So it does align with Keir Starmer's policy agenda. Stargate, which is the sovereign data play that OpenAI has lent into alongside Nvidia. look, they're going to make some commitments. The question is, do we have the power and the capacity in terms of energy to support this data center build? And really, it's a drop in the ocean when you compare it to kind of spend on data centers you're seeing in the UAE and the US, where you're talking about 4.5, 5 gigawatts in terms of data centers. Here we're talking much smaller. But nonetheless, it is a step. It will be seen as a step in the right direction.
You've had an amazing conversation with the CEO of Alphabet's Isomorphic Labs. Talk us through what he had to say. This guy's one of the leaders. You want to listen to what he had to say. And it's not only what's happening with the AI story, but also what's happening with the medical science story.
Yeah, and that's really where the focus was. So Demis Hassabis, Nobel laureate, and alongside Sam Altman, really one of the key players in terms of delivering on AI and that historical legacy in terms of, for the last decade, thinking about artificial intelligence. The focus was on this huge mission statement for Isomorphic Labs, which sits under Alphabet, which is to solve all disease. The reason you take that mission statement seriously from Demis Hassabis is because, number one, he's Nobel laureate, and the reason he is because this is the team AlphaFold, also Isomorphic Labs, the team AlphaFold that solved the protein folding question that many thought was impossible. Take a listen to what he had to say specifically about whether or not they can eventually possibly tackle the question of cancer.
The kind of holy grail in a way is to try and tackle cancer, but we've also done it for practical reasons as well, because the clinical aspects of that are favourable for new drugs, because obviously the disease is so serious.
The other key line that came through from Demis Hassabis was how they plan and hope to shorten the drug discovery phase. Yeah. And they think they can get that down from a number of years, sometimes 3-4 years, potentially to a number of months, even shorter, within a couple of years. That's what Demis Hassabis told me. There's, of course, the clinical phase part of it, which is 6 to 7 years, which they will look at some point. But in terms of that first part of the drug discovery story, they think they can shrink that possibly to months, possibly to shorten that. And that of course, if they are able to do that, would be hugely significant.
All right, thanks for joining us on the latest on European tech. That's Bloomberg's Tech Europe's anchor, Tom McKenzie. But joining us now for more on tech is Storm Uru, the co-manager of Liontrust Innovation Team at Liontrust Asset Management. I want to just start off with whether you think this incredible rally we saw in Oracle, the numbers that they were putting out in their earnings call, do you find them believable?
Good morning. It's great to be on the show today. So I've just got back from Silicon Valley yesterday, so I've got a little bit of jet lag today. Claire and I were first in New York, kicking the tires on a number of new IPOs that have come to market, particularly in crypto, a number of new types of companies, which are very exciting. Then we spent 3 days in Communicopia, Goldman Sachs' big technology conference, listening to the biggest technology names across the sector talk about, one, what they've been up to for the last year, and two, where they're going over the next 12 to 18 months. And the message was very clear, particularly from the AI labs, is that they are very compute constrained. The question for us over the last 12, 18 months is who is going to build out the data centers? Who is going to get the ability to build the new data centers going forward? We got the answer to that earlier this week with Oracle.
The question that everybody else has asked has been, is it real? Can the LLM companies spend this kind of money, burn this kind of cash, deliver to Oracle this kind of business? Oracle missed, and they came through with this very spectacular outlook statement. How easy is it going to be to thread that needle? How easy is it for these companies going to continue to spend at these kinds of rates? I read a note from Richard Windsor this morning talking about the fact that ultimately he thinks that there is going to be a crunch point coming, that actually the business isn't going to be there, and as a result of which this cash burn is going to become untenable at some point. Is it that binary? Is it kind of success, massive success, or ultimately some of these companies are going to get crunched?
Yeah, I mean, I just think we're just too early to be having this type of discussion. Right, the reason why is because if you look at the cost of OpenAI to build its most recent GPT-5 model, it was around about $2.4 billion. They're now generating north of 13 billion average run rate revenue right now. So 2.4 billion investment, around 13 billion in revenue. That is a very high return on investment in terms of build. Now we're going to a high level of build going forward. The key other vector of demand going forward is around inferencing. And when we're talking about inferencing, the key factor here is moving from single-shot ChatGPT to reasoning. And the reason why that matters is because reasoning requires 100 to 1,000 times more compute. That's the reason why we need these data centers going forward. And if you look at OpenAI today, only 7% of their consumer cohort are actually using reasosoning today.
Sure, that's fine, but where's the money coming from? These companies are burning cash at epic rates. They're having to pull in cash. It was at OpenAI, I think the information was reporting this week, that they're having to raise the amount of money they're going to need. They're talking about their profitability. Yes, they're going to get greater revenue off this. But the amount of money that they're going to have to burn through to get to the point that they want to get through is just getting bigger and bigger and bigger. And I'm wondering if there comes a point where that is not tenable.
There's no doubt we're going to come to that point at some particular
When do you think that's going to be, though? When does the Darwinian moment come?
That is the big question. If we stop today, so we no longer spend any more money in terms of building smarter AI systems, it could take up to 10 years to deploy the available applications across the ecosystem.
Right, okay.
So we're talking about tremendous value creation that's happening. It just takes time to deploy across the economy. We have never seen companies be able to scale their revenues at this rate before, going from zero last year to $500 million of average revenue run rate today. This type of business model hasn't existed before. This is the reason why, one, we're having this level of investment, but two, is also an arms race. And you've got the very large incumbents, Microsoft, Alphabet, Amazon. They're on the wrong side of this, and they're spending to get onto the right side of this. They're going up against new competitors like Oracle, like OpenAI, that are going after their business.
But Storm, surely there must be some sort of bottleneck you're worried about. You're saying that everyone is telling you in Silicon Valley they need more computing power. In building these data centers and trying to get the electricity and trying to get the water to cool them, surely there is a bottleneck somewhere that does worry you.
Without a doubt, there's bottlenecks everywhere. The key question we were trying to work out last year, where is the return on spend? Now we're starting to see it across the broader economy. We just talked about drug discovery. That's going to be a 3 to 5 year story. We're talking about code vibing today. That's a killer app. That's the second killer app after ChatGPT. So vote coding means that even I can sit there this weekend and I can build an application. I've got no coding experience whatsoever. And that is just crazy. The impact that that's going to have across the broader economy, being able to digitise the analog economy, because up until now, software engineering has been the key bottleneck. So this technology is already starting to unleash key parts of the bottlenecks across the economy. But what we haven't seen is a tremendous increase in revenues and profitability across the broader economy yet. And then that's what's going to encourage and give the payback for this increased data center spend.
Yeah, and just a wider productivity gain.
Exactly, but I mean the data center build up when we moved to the cloud, it took time before they got the payback on that initial investment. This is exactly the same transition. So you transition first from the mainframe to the enterprise, and then enterprise to the cloud, and then cloud to the AI infrastructure builder. It just takes time. The investment needs to come first, and then the revenues.
Well, speaking of investment, the U.S. government has been a big part, a big driver, a big supporter of this investment. The Trump administration, we've got 3.5 years left, right? Perhaps this government investment isn't as bullish next time around, and you're talking about timelines that are way longer than that. Is government investment something that's needed in the long term to help this, or is that not part of one of your concerns?
At this particular point, it's the speed of build that's important, and so there is an arms race between the US and China, and for systems to get through these AI systems to get smarter from this particular point, the size of the compute that's needed to generate ChatGPT 5 or 6, but then to go to Grok 5 requires 10 times the compute that's been required so far. And so, therefore, the data center build-out is required at this particular point over the next 2 years to compete on the broader scale is quite significant. What that means is that deregulation is important. Speed to build these data centers is important. But then these systems need to continue to get smarter, otherwise the payoff will not happen.
It's great to get your take. Really appreciate it. Fresh off the plane. Thank you very much indeed for managing the jet lag.
He's just made me think we're worrying about all the wrong things. Obviously, he's giving us the bullish take on the matter, but he's shrugging them off as if that's not the key issue right now. The key issue is how quickly we can get this money and this investment in place, how quickly we can build these data centers in order to help that blockade on computing power.
Yeah, but where does the money come from? That is the key question. And what rate does it come at, I guess, is another key question.
And if the U.S. enters a slowdown, maybe or maybe not a recession, is that money still going to be there?
Absolutely. There's many key questions. Storm, it's great to see you. Thank you very much indeed for stopping by to see us. We always appreciate your and Claire's time joining us on the show. Storm Miran, co-manager of the Lion Trust Innovation Team at Lion Trust asset management. Seems to be coping with jet lag better than me. Coming up, tensions rising on NATO's doorstep after Russia leads to a mobilization of troops in the eastern part of Europe. We've got war games taking place as well. Belarus is the key focus. We'll get the details of all of this next. This is Bloomberg.
Welcome back to the opening trade. We're just over 50 minutes into today's trading session, and the green on the screen has faded slightly into the red. Euro Stoxx 600 trading unchanged. We have the CAC in the red. The DAX is just holding on to small gains. Over on Wall Street, also have the S&P 500 in the red, down 0.1%. Well, over to geopolitics. Tensions have been dialed up after a volley of Russian drones breached Polish territory this week, prompting the government in Warsaw to seek a NATO response. Poland's Prime Minister Tusk said that the drone incursions were not a mistake, disagreeing with President Donald Trump's view that the incident could have been an error. Well, Bloomberg's Francine Lacqua has a new show, Leaders with Francine Lacqua. On the first episode, she spoke to Finland's Prime Minister Alexander Stubb about the situation with Russia.
It's not looking good. You know, I'm very honest with you. With the current regime and with President Putin, I don't see big change. You know, nations that don't have a capacity to deal with their past, they have a very difficult time to look into the future.
Well, Francine Lacqua is with us now and joins us on this premiere of her new show. Francine, what a guest to have, and what a timing to have this guest.
Yeah, he's been quite pivotal, actually, in all of the negotiations between Donald Trump, the European Union leaders, and, of course, Vladimir Zelensky of Ukraine. Now, it's really interesting speaking to such a leader from a small nation, but remember, it actually shares the biggest border with Russia, about 890 miles long, that he had known for a long time that actually Russia and Vladimir Putin was not to be trusted. So he explains that it took a little bit longer for allies of NATO to come to grips with that realization. But again, he also has a really interesting story because he was in politics, then he didn't win, he left politics, and here he kind of lays out the fact that he really has gone back to politics to fight Putin. Remember, 2022, you know, with the invasion of Ukraine was a real wake-up call for Finland, and it's the year after that then they joined NATO.
Can I just say the whole thing just feels very Finnish, sort of brooding and dark. And it's
a bit scary.
Yeah. No, it's a bit scary.
Serious.
No, it's serious and scary, and you kind of get that from him in as much as he clearly is worried. This is a... We all grew up, we knew what the Russian threat was, we kind of knew it existed, the Cold War kind of ended, but it feels like it's back, and it feels like this is a kind of pivotal moment in it being back, particularly this week once you've had the kind of the Polish incursions. Right. He is clearly a worried man.
Yeah, he is, but again, I think that the closer you are to Russia, geographically,
and you don't get much closer than Finland.
Worried, right? You are. So we also went to the border, and you see the kind of miles and miles of dogs and the police and the big barricades, because you just have a feeling that anything could happen. Again, it's something that a lot of the Nordic countries and Poland have had to contend with for a long time. There's military service that's an obligation in Finland. Yep. You also have bunkers that they use for swimming pools at the moment, but they're just set up very differently to some of our Western countries.
We're going to bring that up. Sorry, bunkers are used as swimming pools.
Yeah, so they have bunkers that you could, that at the moment are like places of recreation in the middle of the capital. But if you need to use them, then they're there. And they've always been, a country, again, it's a small country, if you look at the number of population and people that live there, but that they're prepared.
Right, so war and swimming go hand in hand.
In Finland.
Yeah.
All right, that was Bloomberg's Francine Lacqua, and you can watch the full interview with Finnish President at 5:30 p.m. in the UK or 7 p.m. Eastern Time in the US. You can also watch it on the Bloomberg website and on the terminal. It's the first of 6 episodes in the first Leaders with Francine Lacqua. Fran sits down with the decision makers shaping our future to explore the personal stories behind their public personas. Well, let's look ahead to what else we have on the front when it comes to the day book. We do have some ECB speakers speaking later this morning at 9 a.m. We hear from ECB's Olli Rehn at 9:15 from ECB's Nagel speaking in Frankfurt. Later this afternoon, the attention goes to the U.S. The last big data print of the week is the UMich Consumer Confidence Sentiment Indicator, which also has that underlying inflation expectations component that is hotly watched by the street. And then after the market, the Fitch review of France.
OK, Fitch review is going to be kind of interesting. But the point that was being made earlier by Volsa Morti over Mundi, it's in the price. We are anticipating that we are going to see some downgrades here. And that's why we've got Italy and France trading at the same level.
No, but it's very interesting to read the rationale and whether they say anything about the current political environment and what they need to see from the next new government in order to prevent perhaps a further negative
that's
watch
not the
on
current
their
government. That's the next new government you're talking about here.
I know we've had very many, but the next one formed, the prime minister and what he's going to pick as his cabinet in trying to tackle the deficit. Maybe they say a number that they need to see on the deficit projections in order for France to maintain this rating.
New York Fashion Week, just heard about that. You're not going, I'm not going. No, that's not important. Rugby World Cup, Women's Rugby World Cup. I think we're into the quarterfinals now. Pay attention to that one. I think the Premier League is back after the international break. The Rhine in Flames.
It's a weird title, but it's a big fireworks show.
It's like 5 different centres along the Rhine with fireworks.
It's not a protest like in France. It's fireworks of celebration.
Yeah, OK. Sounds like it's fun. World Athletics also on the docket as well. It's going to be a great weekend. Have a great time. If you've got some spare time, Bloomberg Weekend Newsletter is something you want to be paying attention to. Fran is going to stay here. The Pulse is next. This is Bloomberg.